You gotta be flipping my flapjacks. We got so much to get into in today's video. I hope you guys are ready for our beast one. Sit back, relax. We got a lot to go through, a lot of important things to discuss in this one here today. Public count closing at $3.74 million, up $36,000 here today. Congratulations, everybody out there making a few dollars for your name, right? Had a lot of big movers here today. Salesforce up 3.6%. Meta, very nice move. Meta was up $35,000 in the public count here today. Estee Lauder is so sneaky. Look at this stock. Up another 1.75% here today. Now we're up almost 50% on Salesforce stock, up $61,000. That one's just a sneaky gainer there, EL. Shopify is another sneaky gainer for me. I have this as a position in the Patreon portfolio, not the public count, the Patreon portfolio. Now up 145% on this stock. It's all the way up to $162. It just continues to roll higher and higher and higher. And, you know, it's not the most talked about stock, but man, there's some stocks out there that are just absolute beauties, and the Shopify is one of those. Two things I want to get into before we get into the reactions in this video, okay? One is I'm going to show you all the sells I've had in the public count this year. Every single one of them, we'll talk about it, okay? Second thing I want to get into is the next thing I want to sell, the next stock I want to sell, okay? So we'll get into all that at the very beginning of this video. From there, what I want to get into is some reactions. Oh, well, I also have to talk about something very, very bullish if you're an Estee Lauder or ELF shareholder out there, okay? So we'll speak about that. Then I want to react to this video here from Mike Wilson 24 minutes ago. Recent market weakness will lead to medium-term strength. That should be an interesting one to react to. Market is on its way to a Santa Claus rally, says Bank of America. That should be interesting. This one's crazy. For too many young people, investing is like gambling. It's a warning sign. Huh. Okay, so looking forward to reacting to that one. That should be interesting. Like, should young people not be investing? Like, what is going on here, okay? Stocks have a pretty good backdrop for 2026, says Piper Sandler. Looking forward to reacting to that one, sharing my opinions and perspectives. Bryn Talkington sold out of Salesforce yesterday. What? I'm looking forward to reacting to that one because Salesforce I've been buying very, very heavily here recently. So I always like to hear when a Wall Streeter is selling one of my stocks. And if you watch yesterday's video on the main channel, you know, that should be very, very interesting. Okay. I appreciate y'all for joining me as always. Thanks so much for being here. One thing only I need from you guys. If you could just hit that little thumbs up icon. If you haven't done so already, please do so. And to everybody that's already done it, thank you. Thank you so much for going ahead and doing that. If you want to be subscribed here, you can certainly subscribe. We are now at, how much? Dude, I don't even know. I don't even know how many subscribers we have on this channel now. I don't even want to say a number because it might be completely wrong. It's a good amount, though, and I appreciate each and every one of you that are subscribed here to the channel. Additionally, pinned comment down there today if you're looking to apply to join a private stock group, private wealth group, all that good stuff. That's access to all my course curriculums, private Discord chat, see the moves I'm making in my multi-million-dollar portfolios, all that good stuff. We are now up to 3,142 members. I am shutting the group down to new members at 3,300, ladies and gentlemen. So that's only 158 spots left open for the private group this year, and that's not very many. And at some point in 2026, I'll open it back up, but I need to give my guys a break. It has been ridiculously busy for them this year. And you got to understand, like, I don't think people understand, like, you know, the people that are on my team that work for me, these people are all stock market investors, and many of them have multi-million-dollar portfolios. Like, I'm sure a lot of you guys have spoken to Andre before. Andre's got a portfolio of several $1 million. You know what I mean? Like, these guys, they need time for themselves and to look into stocks and, you know, how to run their portfolios and all that good stuff. Like, you know, so it's just been flat out super, super busy, and I'm super happy. You know, people are taking investing more serious and join the private group and want to get access to 1000X and all that good stuff. Like, you know, level up, baby. But it's been overwhelming. So we're going to shut it down here, 158 left open spots, and that's not very many. That's gonna fill up like that, and then we'll be shut down, and we'll open back up at some point in time in 2026. But I need my guys to catch their breath because it's been too dang much. Okay, alrighty. So let's get into this. Here is every single stock I have sold this year in the public account. Okay, so right off the bat, I had some Duolingo put options. Let me be the first to say I made incredible gains on that in a very quick amount of time. 37.9 I put into it, and I ended up taking out 57, right? So $19,000 gain, and I think that was in a matter of like weeks. Let me be the first to say I made a huge mistake not holding those longer. I could have made a $40,000 or $50,000 profit on that if I just held a few months longer. Just a few months longer, I would have walked away with a $50,000 profit on those put options. They didn't expire until March of 2026. But here's the thing. When we're talking about hedges, which if I buy put options on a stock, it's because I'm hedging my portfolio, right? Because I think there might be downside in the market, or I just want a little insurance. No different than you have health insurance, auto insurance, homeowners insurance. Hopefully you never have to use it, but if you do, it's there for you, right? And so Duolingo is kind of a hedge about if this market goes south. Duolingo is probably going to go south. Stock's probably going to go south anyways. So if the market gets hit a little bit, like that's double whammy. But I just took the profit, man. I took the profit too soon. $19,000 is $19,000. Like, it's nothing to sneeze at. Like, I think back to the days I worked at Quick Trip and I used to make $50,000 a year and I thought that was a lot of money, right? And, made that in a few weeks on those put options. Just a very small hedge there went a long way, but I could have made 50,000 plus. So it is what it is. Costco. I made $9,500 on some Costco put options. That was early in the year. Toll Brothers, I had put options there. I made $7,800. Walmart, I had put options, made $7,300. And the best part is, I made a lot of money with put options this year in the public count, and it wasn't even a bad year for the stock market. That's the most ideal thing. And additionally, all these positions I actually sold too soon. If I would have held them just a few days, few weeks, or a few months longer, I would have made more money. But the moral of the story is, when the market's going up and you can still make money from your puts, for your hedges, from your insurance, it's like getting it both ways. Like, that's perfect. That's ideal, right? Monster, I had a small position on Monster. I sold out of that early in the year, took a $5,600 gain there. Celsius, took a small gain there, $4,500 on just some shares. At the end of the day, I shouldn't have sold those. That was just a mistake. Celsius is still a significant position in the public count, but that was just a mistake. Whirlpool, I had a very small position there. Then I moved out. Thank goodness I did that. It took $339 in profits. That was just one of those that, it just was what it was. Adobe, I think I put that money into Salesforce. I felt like I was a little overexposed to Adobe, and I think I put it in Salesforce, if I recall. So it was just $213 profit there. So that was just kind of like things like Whirlpool, Adobe, just very small moves. Even the Celsius move there, even the Monster move, right? For a portfolio that's nearly $4 million, these aren't like big moves. It's just like small little stuff, right? Palantir, this was a big move. So Palantir put $17,700 in those shares, ended up exiting with $307,000. So can't complain about that. Took long-term gains on Palantir of $289,000. Keep in mind, if you see me take short-term gains in a stock, it's usually going to be little money. If you see me take long-term gains in a stock, it's usually going to be big money, right? Because some of these smaller ones can be like hedges, like these were, or it could be situations where maybe I was in a stock and I never built it out into a big position, so I'm like, this is in no man's land, I need to sell out of it, things like that, right? Now, in regards to Palantir, listen, I would have been better off keeping all those shares. You know what I mean? Like, I've made so much money. How can I complain? I'm not complaining. I'm just saying, like, I would have been better off keeping all my shares. The bottom line is, when it comes with the stock, if I feel like there's a low probability of making money in that stock over the next 3 to 5 years, I have to move out of it, right? And so with Palantir, I sold almost all my shares in all my portfolios. I have very small positions left in Palantir. I have a position in the Patreon portfolio. I have 1,000 shares in the public count. I have hardly any Palantir. Now, keep in mind, 1,000 shares is still, $177,000 or whatever, but it's very insignificant. And that's because I believe Palantir does not have much upside ahead for the next 3 to 5 years, essentially. I could be wrong about that. I'd be happy if I'm wrong about that, just to be quite frank. At the end of the day, I have 1,000 shares, and plus I have it in the Patreon portfolio. I don't think I have any shares in my private portfolios of Palantir. So, but moral of the story is, it's just the valuations just ran so heavy. The forward P, the 2-year forward P, it's going to be very, very difficult to make money in that stock, in my personal opinion. Unless if they keep growing at 60% revenue, year in, year out for the next 3 to 5 years, well, there's going to be a lot of money to be made still in Palantir. You'll see that company go $1 trillion plus market cap. But I do not believe the 60% type revenue growth they've been putting up recently. I don't believe that's sustainable. I believe that's a short-term phenomenon, and then they're going to probably even out at more in that 25 to 35% revenue growth range, which is phenomenal. But that basically will make it very difficult for the stock to be a money maker 2026 through, we can call it 2030. Okay. Revolve took a $3,000 long-term gain there. That's still a decent-sized position in the public count. PayPal did a little positioning there, $982 gains. PayPal still a significant position in the public count. Meta took some profits there, $53,000 profit. That was $17,000 of cost basis there, and took $70,000 out. So $53,000 in long-term gains. That was just, a little overexposed to Meta. I want to diversify a little bit, so I sold a very small amount of shares there. Meta's still a how many? I don't know. I think Meta's either $1 or $1.2 million position, something like that in the public count. Tesla, I obviously sold out completely out of Tesla, right? You could say I definitely could have been better off if I held those shares for sure, right? $266,000 in long-term gains. The good thing is with some of these stocks is it's always nice to be able to look back and say, darn, I should have held for longer, right? I could have made even more money. But at the end of the day, when you put $13,000 into a stock and you take out $279,000, like, it's hard to complain about that, right? I could have been a little better off, but it is what it is, right? This is basically nothing here. PLTZ took a $1,500 loss there, and then I sold out of that one. The hard thing with that one is Palantir is just so strong fundamentally as a company that although the valuation is insane, and although I don't think there's much upside potential for Palantir for the next several years, right, it's a hard stock to bet against when the fundamentals are as strong as that company is, right? And then Planet took an $80K long-term loss there, and then about $4,700 short-term loss in regards to Planet. Tough thing with the Planet is, I really like that company. I like the management team over there. The industry is obviously a massive industry. It's just the government keeps screwing this industry. They make it insufferable for these companies to ever make a profit and succeed, and it's just brutal, man. And so you're just stuck with these companies that are like, they have so much potential, but the government's just not allowing it. If the government ever gets out of that industry's way, like, these companies have years and decades to run. So I'm keeping an eye on the industry. I still have some shares in some other portfolios. I'm keeping an eye on the industry. If I feel like the government's finally going to for real get out of the way and it's not just rumors, because we've heard so many times, oh, this administration's going to do this, and oh, the politicians are going to, and they never do anything. If I actually see some action, then we're talking. Then we're back in business. I can position into these, because then those stocks could actually be ready for multi-year runs. It's not like, even if I miss the first initial pop on those stocks, who cares? Those stocks would then be positioned for 5, 10, 15, 20 years of gains. But the government has to get out of their way, man. And the government just continues to be there. Now, next up here that I'm thinking about selling in the public count is my TSLZ. This is my Tesla hedge here. So this is one that hasn't gone well so far, down about $5,100 on this one. My thought is I'm planning on keeping this into the first quarter. My guess is probably till February or March. We'll see. But this is one I don't want to be in long term, right? Tesla's a really tough one. And as any short seller will ever tell you, Tesla's a tough company to bet against. Very, very tough. And the reason being is it's just like the company's trading at like a $1.5 trillion market cap. It makes no sense. The forward P is like at 300 something. The 2-year forward P is 222, and we'll see if they can even increase profitability that much over the next several years. A price to sales ratio is astronomically high. It's all ridiculous. But just because it's ridiculous doesn't mean it needs to go down. In the short term, at least, like, could take a year for it to go down. It's ridiculous. It's out of control, but it is what it is. And so, man, tough. We'll see what happens. I've also thought about doubling down, in regards to that matter, and taking that to an $80,000 position or something. So I don't know. We'll see. The bottom line is with that insurance, it's tough, man. It's tough, especially some of these dang companies, okay? Alrighty, next up here, we've got some bullish news after hours here that just came out in the last hour or two, and that is Ulta. Ulta earnings came out. From what it looked like, they beat revenue estimates by around $150 million. Some people had them at $180 million beat. So let's just call it $150 million to $180 million of revenue beat, right? So revenue is stronger than expected. What does that mean? Okay, first off, I don't care what Ulta's profitability is, right? Because I'm not an Ulta shareholder, so it's irrelevant to me. What I do care about is how their revenue is trending, because if their revenue is much stronger than expected, then that means what? They're moving more product than what they expect. And if they're moving more product than what they expect, then what does that mean? Well, that could be bullish for companies like Estee Lauder, could be bullish for companies like Elf, right? Elf has very nice positioning in the Ulta stores. And so Estee Lauder has some brands, some products in some of their stores. It just depends. It's kind of a hit or miss in regards to that. Overall, that's, I would say, a bullish trend. If Ulta came in and missed revenue, I wouldn't feel too good about that. Additionally, this doesn't even have November in it, right? This is, as of October 31st. And from what we've seen, spend looks very, very strong out there in November for a holiday season. So, bullish for Estee Lauder, bullish for Elf. Those two companies, I don't stress about them at all. EL's a sneaky gainer. The turnaround's already started in regards to Estee Lauder, and they seem like they're just starting to hit their stride again. And as Wall Street gets more confident in Estee Lauder, they're all going to come flooding back to that stock. Because remember, there's something I want to make sure everybody knows before we start reacting to videos, okay? It's a little gem dropper here. Wall Street loves certain stocks for certain reasons, okay? It could be because of their margin profile, could be because of trust in the business model overall, could be various different reasons, right? Nike has always been an example of a company that Wall Street loves, right? They haven't loved it the last few years because the numbers went really south because of the previous management team. We don't need to go into all that, right? But the bottom line is, like, if you look at Nike's history over time, Wall Street loves it. As soon as the numbers get right again, they're all going to come flooding back to that stock. What is another perfect example of a stock that Wall Street has always loved? They haven't loved the last few years, but man, they've always loved the stock historically. They're already starting to flood back to that stock. It is EL. Estee Lauder. They've always loved Estee Lauder. The margin profile of that company, consistent revenue growth, multitude of brands. There's not just like one brand goes under and then they're screwed. There's a multitude of brands there, right? There's many different growth levers for the company to pull from. They love that stock. And so they're already starting to flood back to it because the numbers are starting to reflect positive again. And so as that happens, more and more momentum comes in, right? And what's impressive about Estee Lauder is how much strength it's showing here at the end of the year, considering we're in tax loss harvest season. So, and that's a stock that I would imagine, not many people have made money on other than myself or a few people that have bought in this year. And so the fact that that stock is so strong even during tax loss harvest season definitely shows that I believe there's been an inflection in the numbers in regards to Estee Lauder, and it's just sneaky. It keeps sneaking up. It'll be up 1%, 2%, 3% in a day. No one really looks at it, and it's just sneaky gains. And keep in mind, when you get a 1.7% gain on another 1.7% gain on another 1.7%, the number starts to become a lot bigger over time, right? Because everything starts to compound. So this is something I kind of keep in mind there. So bullish. Okay, let's react to a bunch of videos here. Oh boy. This is a banger. We got a lot to go through here.
Continuation of this year's story. I mean, we had a view coming into the year that they were going to probably do the growth negative policy stuff first, and it turned into sort of kitchen sinking it. And that all happened faster and more dramatically than even we predicted. So that when they flipped the switch in April, I mean, now we're looking at this just reversion of all of these revisions that got so negative. And now, I mean, to be honest, some of the stuff they've done has been even more constructive. I mean, the big, beautiful bill turned out to be much bigger than we thought, particularly from a CapEx incentive standpoint. There's a real benefit to the consumer in the first half of next year in terms of tax cuts and tax benefits from the SALT deductions increasing, as well as the tax on tips, et cetera. Then you have the story with the Fed now kind of turbocharging this story. So you've already had the earnings revisions. The Fed's now is going to be, tailwind at your back. And this is the broadening out story that I've kind of referred to several times in the show already. So this is where I think investors have to make a choice. There's a fork in the road now, as Yogi Berra would say, take it. Okay, we're going to take the fork towards the broadening out. And that would be areas like consumer discretionary, some of the financials that haven't performed. Some of the financials have done really well, but there's parts of the financial sector that haven't done well. Transports, you mentioned that. That's an area that's really suffered. Some of the commodity patch hasn't done particularly well. Consumer goods over services. So there are plenty of things in the market that have not worked yet, that don't have high multiples, where the earnings are going to surprise on the upside. You get multiple expansion and earnings growth. So you see the benefits of the tax bill. Any of that offset by increased premiums for healthcare with the roll-off of these subsidies? Because, that's a big number. But then you might say, hey, listen, that's a lower earning, consumer. So maybe it's not that big of an impact on the broader economy. That's right. And the immigration restriction, because that clearly was a funnel for consumer spending, but once again, lower end spending. So it's a good trade-off. The biggest beneficiary of the bill is the middle income cohort, and they have a high propensity to spend in areas that we're talking about.
Okay, so I mean, there's so many various things that can happen here. What does the Fed do? Into 2026, I think that's going to be a big debate. Does the Fed keep lowering rates? If they are lowering rates, is it because they feel like the economy is going south? There's a lot of factors at play. The biggest, what the biggest thing that comes to my mind is in regards to trying to judge if the market's going to go up, over the next 3 months, 6 months, 9 months, 12 months. The biggest thing that comes to my head, Bitcoin. Bitcoin has shown stability here recently, and the stock market's shown stability. If Bitcoin starts going south again here in the next few weeks or, next year, the market could get shaky again. So, I'm actually watching Bitcoin price quite significantly and will be for the next several months, because it's going to tell you a lot about where the market in general is headed at. If we can see stability there and it just kind of slowly goes up, I think we're fine. But if you see Bitcoin start to weaken again, don't be surprised if this market takes a turn lower.
It's here. You got your 2020.
But what does all that mean long term? Nothing. So what do? You buy great companies at attractive prices. Keep it simple. This is entertainment. We can talk about where we think the market's going to go short term, medium term, blah, blah, blah. But at the end of the day, remember, don't make your actions based upon what you think might or might not happen in the stock market short term, because you don't know.
26 outlook finished up, ready to go.
So he doesn't know. Mike Wilson doesn't know. I can tell you that much. We just watched. Mike Wilson was so wrong. It wasn't even funny a couple years ago. So, in trying to make his market calls. So keep that in mind.
Plan of attack that you're talking to investors about.
Well, right now, the momentum, as you already stated, is that this is an elf rally right now, on the way to a Santa Claus type of rally. So we're just beginning this right now. We had a lot of...
So they're working on it. You got to finish it up.
Right. They're in the workshop right now, and then ultimately delivery happens later. So why is that the case? Obviously, tailwinds coming in the first quarter of next year. Really, between February and April, you might see some good tax refunds, fiscal bill relief on the consumer side. Consumers already resilient. Boomers are spending. They're the biggest growth area, masking over some weakness in some other areas. But then you get the actual corporate tax relief as well. Tax probably not the right word, but just in terms of fiscal bill relief, you get a couple of tailwinds. CapEx still moving forward. But the critical point is when have we seen the Federal Reserve cut rates into a growing momentum economy? Been a long time.
Yeah.
We know why. But at the end of the day, the third mandate, which is price stability, arguably speaking, asset price stability, is alive and well. And that gives us a very good comfort level for 26 being a proud bull, Mike, versus a stampeding bull.
What does that translate into a proud bull in terms of, if it's not stampeding, so what? It's not going to go up 20%, or it's just going to hold its ground?
Not going to go up 20%. Okay. We've seen that 23, 24. We're on track for that in 25. A proud bull is more, let's track earnings growth. Let's not expect multiple expansion. Multiples, we all know it. They're vulnerable. They're vulnerable to a negative growth shock, which we don't believe is our base case. When we look at profit growth being 14% or so, that could prove to be low if all stars align. But there's not a lot of downside in that profit growth number.
It doesn't seem like it. There's a lot of confidence in margins holding up, and I guess just the momentum.
So this is where we get into a very interesting debate, because this gentleman just said what? He said the Fed is lowering into, basically like a strong economy or a strengthening economy, those sorts of things, right? Which is very interesting. It's a very interesting comment, because there's plenty of people out there that say this is not a strong economy, this is not a strengthening economy, this is a weak economy right now. So that's where you get into an interesting debate right now. We got some individuals say this is a good economy, we're strong right now. And you got other people that say, no, this is not strong, this is a weak economy right now, right? So what do you believe, right? Like, what's your perspective on it? Is it strong? Is it not strong, right? And I think it really depends on the sector. It really depends on what area you're talking about. Is real estate strong right now? Absolutely not. Absolutely not. Real estate's been dead for years, right? Are auto sales strong right now? I wouldn't say so. Stock market. Are the financial markets strong right now? Absolutely. Very, very strong, right? So it depends where you're at in this economy. I can't describe this economy as strong. I also wouldn't call it super weak. I think we're kind of meh. That's the best way I could put it. A truly strong economy is one where you feel like everybody's doing well. You feel like the financial markets are strong. You feel like real estate's strong. You feel like people are out buying new cars and buying new flat screen TVs and, spending on their homes and all that stuff. Like, that's a real, like, feeling of strong economy. Like, ooh, we're doing well. Like, everything's just going well. I can't say that. I also can't say it's a disaster. I can't say this is, oh man, we're so awful out there. I can't say that, right? Inflation's come down immensely. Wages are good. As far as unemployment rate, it's still pretty dang low. So, I feel like we're kind of in a meh right now. We have the potential in 26 to take it either place. But with some of the positive tax changes that are going to happen, we have a potential of the consumer strengthening in 26, especially if we can keep housing inflation at bay, insurance at bay as far as price increases and things like that. If we can keep a lot of that at bay and energy prices stay low, because actually energy prices are really low right now as far as oil and natural gas and whatnot, if that can all stay at bay, I think we could have a much stronger consumer in 2026.
I mean, at least in the biggest companies because of the CapEx trade. How do you think it breaks down, though, in terms of how much faith investors are going to place in everybody winning on the AI trade and not? Because we've already seen the market try to sort things out. NVIDIA's forward multiple is down from 35 to 25.
Right.
Microsoft's down from 33 to 28 in 4 months.
Right.
Because, the earnings are going up, but we're not sure what we want to pay for them.
Yeah, I think that's well stated, because you had significant speculation in a few pockets across the marketplace. 3 or 4 of those pockets have basically declined into this, but yet the market held up. So what's happening is there actually is a broadening out happening. With better growth, more people participate. So we expect better participation, but still tech just hanging in there.
Yeah.
Their multiples are now a little bit more attractive. But what people don't really look at too much anymore is Mag 7, 5 of them have underperformed the S&P. The terrific 2 are the ones that have outperformed. So really the rest of the market is starting to feed into this narrative of better economic health, but it doesn't mean we're off to the races.
Yeah, I feel like people want to point to that. Only 2 Mag 7 stocks have outperformed. But the upside to those has been huge, and most of them are also up. It's not as if they've gotten left behind fully, but it shows you also how hard it's been to beat this index. I think
it's been interesting. It's such a time of the narrative shifts in regards to the Mag 7, the big tech. Like, the narrative is all over the place. Like, Meta, the narrative was so positive, 4, 6, 9 months ago. So positive. And then the narrative went so negative about, they might be overspending, blah, 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 right? Even though their latest revenue growth was incredible. It was like 26%. Like, are you kidding me? Like, that's unbelievable. Like, for a company Meta's size to be growing revenues mid-20s, it's unreal, right? And then the narrative goes so negative. Then all of a sudden today, you hear the news about they might cut a bunch of spending in regards to the metaverse unit, and stock goes up, right? And so if then that news is confirmed, and don't be surprised if Meta starts to see more momentum. And next thing you know, Meta's at 700 plus again, right? And then Meta's on the way to 800, and then we're gonna see Meta at $1,000. And it's just like, it's crazy, man. Apple, the narrative was so negative around Apple 6 months ago, right? Like, they're not spending on AI, so they're going to get left behind. Nobody's excited about their products, blah, 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 right? Then all of a sudden there starts to be this question about maybe people are spending too much on AI. And then people are like, well, Apple's not spending on AI really, so, they're just using all that cash flow to do share buybacks and dividends and all this other fun stuff, right? And so then people are like, let's position Apple. And they launched some iPhones that are selling very well. And then people are like, let's go, baby. Apple's the way. And then Apple, I believe just yesterday, hit an all-time high. And it's like, Google, perfect example. No one wants a piece of Google 6-9 months ago. No one, except me. And maybe a few of you guys out there. We were buying, right? I remember I bought those shares, April 23rd? And I made, $72,000 or whatever on that little batch of shares I bought. Incredible moneymaker. No one wanted that stock 6 to 9 months ago. No one. Then all of a sudden, Gemini takes the lead in regards to how they benchmark these, AI products, and then Google keeps putting up solid numbers quarter in, quarter out. And next thing you know, oh my gosh, everybody wants a piece of Google McDougal. It's hilarious, man. The narratives are just shifting. It's it's there. It's like, come on, man. Come on. But that's what's going on in Mag 7. NVIDIA was like, everybody wanted NVIDIA. Like, couldn't, I mean, stock went 200 plus. Then all of a sudden, people are like, maybe the spend is going to be toppy in 26, which is what I told you guys are going to start to worry about. And sure enough, they're already worrying about it, right? And then we're starting to talk about competition in NVIDIA, and the competition's coming, right? And it's true, the competition is coming, right? You got all these private label chip makers, you got AMD stepping up. AMD really enters the race in a major way in 26 in regards to their sales bump up. It's going to be insane, especially in the second half of the year when the 450 hits. So, but now I'm starting to, I'll put on the Wall Streeters on CNBC. I'll be, working and listening to them in the background. And all of a sudden I hear them talking about competition this, competition that for NVIDIA. And it's like, it's hilarious, man. Like the narrative around these stocks is all over the flip and flapjack in place. Next one up here. For too many young people, investing is like gambling. It's a warning sign.
Writing recently about his concerns that many young people are investing like they're gambling, which he says is a warning sign. For more on that and on the markets, let's bring in Ron.
100%. I thought I was going to disagree. I thought he was trying to say people investing young is bad. Like, listen, this man is 100% on. There's way too many people in the market right now gambling money. They have no clue how to look at an income statement, a balance sheet, a cash flow. They have no clue how to value companies, how to run projections. No, they don't. None of this stuff. They're like, if I put them on a spot and I'm like, all right, tell me why this stock's a great buy. Tell me about the PE ratios on the stock. Tell me about what revenue growth rate they should have. Where's their earnings per share going over the next few years? What's their share? Be lost. They're just throwing money around, just gambling. That's complete gambling. And the crazy part is they're gambling their whole net worth. It's wild to me. So that is an issue, and that comes back to bite people. You know when it does? When the market goes kangaroo, and when it hits hard, bear markets. And you don't get many of those, but you get about 2 bear markets every 10 years, roughly. Almost a guarantee you get one, but you're likely going to get 2 bear markets every 10 years. And when those bear markets hit, those people that were gambling get absolutely decimated. They're done for, man. They'll lose their, 70, 80, 90% of their portfolio by gambling money in the market. Don't gamble money, man. I teach you guys all this stuff on a higher level, man. We'll send you steel membership cards to your house. We'll send them. Pin comment down there. Get in there while you got a few spots left open, man. Get you a lifetime membership card. I teach you guys all this stuff, or you can just gamble money and, do that sort of behavior. Do whatever you want, but I'm just like, come on, man. Let's take things up to a higher level. I never feel like I'm gambling in the market because I'm making investment decisions. I'm running my numbers. I'm running my projections, right? Doing this stuff on a high level, and it shows in the results, does it not? Yes, it does.
Krzyzewski, Chairman and CEO of Stifel. Good to see you. It's been a while.
Like, what did we have earlier? What did we have here? Let's see here. What did we have? Public count this year, $581,000 of profits taken. $581,000. $532,000 of that's long-term gains. $48,000 of that is short-term gains. So $48,000 short-term, $532,000 long-term, $581,000 total. It pays very well to not gamble in the market and invest and know what you're doing. It pays very, very well.
Not that long, but
I could
I bet.
Longer than we like.
Cheers.
The opportunity. Speak for yourself. No, the opportunity. I was looking for you out in Utah. All your minions were out there, and you weren't there. But okay, so the opportunities for gambling are everywhere. I'm not sure what you're talking about here. Prediction markets, DraftKings, crypto.
Well, it's all of it, but
options. I just heard of perpetual futures.
Well, you know what? Zero-day options and perpetual futures were the beginning of this, and now you have prop bets and prediction markets. And my concern is that if you can pull an app out and in one sleeve buy stocks, which, by the way, if you buy a stock, everyone can win. You're investing in the U.S. economy. There don't have to be a loser. Right. Or you pull it out and you bet whether the coin toss is going to be heads or tails. One is compounding. Investing is compounding, and gambling is consumption. And they are completely different things. And if we, as a society or us as an industry, we need to educate the difference because this has been a gray zone, regulatorily, taxes. These prediction and prop markets are getting a little out of control.
I share your concern with this. But we also sound like old fuddy-duddies who don't want these new ways of bringing new consumers in. Even the SEC chairman who we had on yesterday said it's all manageable.
401k is
I don't
through
know what happened
gambling.
there, but okay.
I assure you that we're not fuddy-duddies, okay? Gambling is consumption. You bet one way, I bet the other. The house takes
it's a zero-sum game.
Well, not only zero-sum game, it's negative return.
It's negative, right.
Yeah. So I think, look, I don't want to be a fuddy-duddy about that, so to speak.
So what he's laying out here, okay, like I get the gist of it. And what he's saying, 100% accurate, by the way. Gambling is consumption. I don't look at gambling. I look at gambling as a bad thing and a good thing. Let me explain. The bad part is when people are just gambling money they should be investing, right? That's a problem. When people are treating their investments and their whole net worth like it's a big gambling game, we got a problem. We got a big problem, right? That's going to lead to very negative long-term returns and a whole host of issues. On the flip side, I don't think gambling, obviously as somebody that lives in Las Vegas and this is a city built on gambling, right? I think in a controlled manner, it's fine. No different than, if somebody wants to spend $10,000 on a bottle of wine, do what you want. Or if somebody wants to buy a Ferrari, and spend $250,000 on a Ferrari, you do you. It's your decision. Where you have an issue is when people take it overboard. And when they're treating their entire net worth like it's a big gambling game. And that's where we run into an issue, and that's where we run into a problem. If some guy wants to, some guy that has a business that he makes $10 million profit a year, and he's got a net worth of, $40 million, if he wants to come down to the Wynn for a weekend and spend $500,000 gambling, it's fine. It's his decision. He's got a business that makes $10 million profit a year. He's got a $40 million net worth. If he wants to go blow $500,000 at the Wynn and have the time of his life, you do you. Go ahead. I'm not gonna judge you bad. If that same man has a business that brings in $10 million a year and he blows all $10 million gambling, we got a problem then, right? He's got no net worth, nothing to show for it. We got a problem then. And so you got problem gamblers, and then you got people that have a little bit of fun, right? You know what I mean? You gotta take apart those two. But there is an issue with people actually just gambling the market, and that's where we run into big problems, right? Because that's gonna destroy your long-term returns. Oh my gosh.
Did I characterize that correctly?
That's right.
And by the way, kudos. What do we call II now?
Xtel.
Thank you.
Yes.
Number one strategist for that call all year long, that there's something bigger taking place here. So tell us what that is.
Sure. The market's been very focused, of course, where interest rates are going and what's been driving that. I would say in 22 and 23 was really more about inflation. And in recent years, we've started seeing the labor market soften. And I suggest that investors have a brief definition of history and have to look further back. And in periods specifically where inflation anxiety was very elevated, like today. And what we see taking place today and for the foreseeable future is softer employment, providing for lower rates, and in a market that's we're seeing inverse correlations with equities and interest rates. That's been a positive.
Yep.
And that is what's been missing to get the market to broaden, get the economy to broaden, lower rates to get manufacturing, transportation, and housing to get back to a better backdrop in 26 when we see that.
If I could put it as the eureka moment as I was reading your work, it occurred to me like this. I keep thinking about, softening employment data and falling interest rates and rate cuts as the end of a cycle, right? That's what was happening in 2008. The economy's softening, the Fed's behind the curve, they're trying to catch up, and that's a bearish sign. But then I read what you're talking about. You go back to inflationary episodes where that's the top concern for the market. And once you have employment softening and the Fed's cutting, then that means you're through the bear market. That actually is the beginning, possibly, of a rally and a broadening. Yeah. So you're pointing to that playbook as to people say, how can we?
The issue, though, is you never actually know when the bottom is. You never actually know that.
Possibly be in the early innings. Look at how strong the market's been. Yeah. Does that give you any concern, though? We'd be building on a rally that's been so strong for the past few years.
Well, I think we have to compartmentalize the rally and where it's come from. We had a big bear market in 2022. PEs collapsed. Credit spreads widened. And it took basically 23, 24 into 2025 to recoup all of those losses. So we had AI earnings, which meant large caps and growth stocks did much better. But look at the Russell 2000. It's back to its highs. None of that is about earnings. It's all PE expansion. And it's because inflation's come way down. Prices are still high, but let's not conflate those those definitions. Yes, the labor market softened, but the silver lining of that is that 2 years ago, interest rates peaked when unemployment started going up. We had mortgage rates of 8%, the 10-year over 5%. And now we're almost 200 basis points lower. And yes, it is a bit of a no pain, no gain situation.
And unfortunately, or fortunately.
So for the last, we can call it 3 years, right? From Q4 2022 to Q4 2025, what was the play? The play was big tech. The play was Mag 7. That's where you make the game-changing money, right? Oh my gosh. AI-related stocks, Palantir. That's been where the big money's made. Where has the big money not been made? Dividend stocks, energy stocks, Russell 2000 type stocks, small caps, real estate type stocks, anything like that? No. Okay? Where do I see the biggest opportunity for the next 3 years? I think the biggest opportunity for the next 3 years is in a lot of these stocks that have been laggers for years. I'm thinking PayPal. I'm thinking Nike. I'm thinking Estee Lauder. I'm thinking a lot of the small caps, the Honestes of the world, the Fubos of the world, a lot of those small cap stocks that have been dead and forgotten, right? Just as these big tech stocks were dead and forgotten 3 years ago, right? Meta, Shopify. Those stocks went down 70, 80%. You know, I showed you Shopify is $162 today, right? Good size position for me in the Patreon portfolio. Guess what? It's like 10% of the portfolio, thinking about it now, right? Of that particular portfolio. Guess what? Shopify was $25 in 2022. People were selling it for $25. That's how bad it got. It's 162 today, right? Meta went to 88. Like, you know, I could run you through all these stocks. Like Netflix has gone up, I think, 600 or 700% since the bottom of where its stock price bottomed in 2022. So those were dead and forgotten stocks. No one cared about them, right? We got a whole new group of dead and forgotten stocks now that are just sitting there, that I think those are going to be the biggest opportunity in the next 3 years. Big tech, there's money to be made in big tech. Mag 7 for the next 3 years. Absolutely, in my opinion. But that's not where the big money is going to be made, in my personal opinion. The big money, the game-changing money, will be in a lot of these other opportunities. That's my personal opinion. I could be wrong about that. We'll see how it all plays out. But that's my belief if we're trying to think about the last 3 years and the next 3 years, okay?
This is a weird thing about COVID. There was a massive hiring surge. Yeah. The fact that we're talking about the Great Resignation and people just phoning in their jobs, like, yeah, thank you that I've arrived. It's not like that anymore. We're unwinding that. Yeah. So Amazon cuts 14,000 jobs. Sounds scary, except that they doubled their workforce to 1.6 million during the pandemic. So the labor market reset seems to be the market is still perceiving this as there is some right sizing going on across corporate America still, absolutely, which shouldn't be confused with kind of where we are in the business cycle.
Yeah, not kind of margin pressure, pain-induced employment layoffs, which is also happening as well, that you've got AI-related layoffs, you've got normalization from COVID, and there is a cyclical component as well, certainly in smaller businesses. And I think that's going to persist into 2026. I want to be clear. I think the labor market remains very sluggish.
Right.
But that opens the door for rates to be to continue drift lower, the Fed to start, to continue cutting, and seeing a broader improvement in housing, manufacturing, transportation. People have gotten so bearish on these parts of the market.
And look at the ISM again yesterday.
And it's still weak, but it's been kind of hanging around. And all of our forward-looking indicators suggest that finally in 2026 we'll start to see that get back into expansion. Up until 3 months ago, we were not seeing those signals.
What are those signals, by the way? It's fascinating.
So it's changes in interest rates, changes in oil prices, changes in money supply growth, changes in the yield curve. And I'm not even including the fiscal policy kicker that we're going to get in 2026.
Because you can do the expensing immediately of depreciation or whatever it is that the people saying it should be half a point of GDP.
In the first half. All of that's gravy, but it's really as simple as 2 years ago we saw interest rates peak after rising into 2023. And they stabilized, the 10-year kind of bounced around for about 2 years and is now near the low end of it. The Fed's been cutting for over a year. It's those changes in rates which help to normalize the economy. And people are getting too stuck, I believe, in the bearishness and kind of thinking that this will never change. And that's where things typically do start.
No, I appreciate
All right, next one up here. Oh, this one should be interesting. Bryn selling out of Salesforce.
Throwing in the towel, so to speak, on Salesforce ahead of the earnings report after the closing bell today. You're not even going to wait to see what happens. Bryn, why are you getting out?
Yeah, well, so I mentioned this on Monday. I've been in this stock for a minute, probably a quarter and a half. And I feel like when the market goes up, it doesn't go up. When the market goes down, it goes down slightly. I feel they're going to have very solid numbers, good free cash flow. We'll hear about some of their new customers. But ultimately, what makes a stock go higher? There's more buyers than sellers. And I feel that Salesforce right now, from a stock perspective, is stuck in the mud. And so I just don't think that we're going to hear tonight anything revelatory that's happening. I just feel like it's a moment in time, and people are not wanting to, put more capital in this name. So I didn't want to sit through earnings in case the market has a negative feedback, which it's done on a bunch of stocks that actually had good numbers. So I just, I wanted to sell before the earnings call tonight.
All right, listen, ladies and gentlemen, listen. What she just laid out there, that's a problem for a lot of investors. They get caught up in this mindset of like, oh, the stock isn't moving short term, and I'm losing money, or I'm not making money, and blah, blah, blah. Don't overcomplicate this game. Listen. Run your numbers, run your projections. Where do you believe the revenue is going over the coming years, the net income's going, the earnings per share? What's a fair PE that stock should be trading at? Does it show that you're going to likely get a great return from that stock over the next 3, 4, 5 years? If it does, own the stock, buy more of the stock. If you get dips on the opportunities, and then adjust your theses as time goes on. So adjust your base case, your bull case, your bear case. If the business is trending better than you anticipated, up your numbers over time. Things are trending worse, down your numbers over time. And then make your decisions based upon that. Don't try to make a fundamental case for it and then backtrack because, well, people aren't buying it, so blah, blah, blah. No. That's how you miss out on a lot of money-making opportunities. Somebody famously said, keep it simple, stupid. Keep it simple, stupid. People way overcomplicate this game. They try to chase short-term gains, and then they wonder why they do so bad over the long term. They look at their returns, they're like, man, how are my returns so bad versus... It's bad because they're so focused on the short term of these companies and what the stock prices are doing. And is the stock price seeing momentum or not? Like, come on, man. It's a problem, right? Make sure you guys check out my video I posted on the main channel, Financial Education. Posted this one last night. New stock I spent $30,000 on today. That covers a bunch of different subjects, but you guys will enjoy that overall. Alrighty, folks, if you're looking to apply to your own private stock group, private wealth group, access to 1000xstocks.com, all of that good stuff. See exclusive weekly videos, pinned comment down there. We're up to 3,143 members, so there's 157 spots open left, and those will fill up quickly. Pinned comment down there. Much love, and have a great day.